Well, hello there, my notary besties. Welcome to your general notary work training, where I help you to become a better notary. So we're going to go over the closing disclosure, and this is going to be a 5-part series because I'm going to dive in deep when it comes to the closing disclosure. So I know that you're asking, okay, what is a closing disclosure? When might I see it? These are very good and valid questions. Closing disclosure is a form, or some consider it as a statement, and it actually shows the clients the final loan terms and their closing costs. Okay, so lenders are required to provide a closing disclosure 3 business days before their scheduled closing. And I just want to send a huge shout out, thank you to our friends at the Consumer Financial Protection Bureau for this beautiful closing disclosure. And I'm actually going to go over it detail by detail so you can be more familiar with the closing disclosure and will be able to answer any questions that the client may have. Okay. Without further ado, let's get into first part of the closing disclosure. We're going to zoom on in is the closing date. So the closing date, you already know that's the date in which the closing is occurring. So this is a date normally that you're going to be in front of the client in closing. Disbursement date. Disbursement date, let's say that this client is doing a refinance, and this refinance that they're doing is a cash out refinance. So for those of you that may not be familiar with cash out refinance is when they refinance their home and the client is getting money back. Normally, the disbursement date would be the date in which the check would be wired, mail, however the client decides to have the funds sent to them. This is how the funds are going to be sent. If the client asks you, do you know when I'll be receiving my money? The client to reach out to the title company on or after the 15th, and they'll be able to give them more information. All right. So the settlement agent, this is really important because this particular closing disclosure that we're going over right now is a purchase. So the client is purchasing a home. The settlement statement is important because this is the name of the company in which they need to wire the funds to, write a check out to, a personal check, a cashier's check. Title companies have their own rules and regulations. If it's over a certain amount, it needs to be wired. If it's under a certain amount, they can actually write a personal check. Here, Epson Title Company, this is the name of the company in which should be on the client's to payment to line, or this is the company in which the client needs to be wiring their money to. Okay, the address. So we need to make sure that we have the client verify, and like I said, this is a purchase, verify the property in which they're purchasing and the sale price. Okay, the next thing that we're going to go over is the transaction information. This is really important because the purchaser, which is a borrower, and the reason why it reads borrower is because they're borrowing money from the lender in order to complete this purchase. So this is the couple that you would have in front of you, Michael Jones and Mary Stone. Okay, have them verify this information is correct. Now, normally, this information would be their current home that they live in, not the actual home in which they're purchasing. But in some cases, I've actually seen this address to match this address. So it just depends. Okay, and this right here is the lender. This is the company in which they're getting the funds from, the loan from, in order to fund this purchase. Information. This is really good. You want to go over this with the client as well. So we see it's a 30-year loan. I already said it, they're purchasing, and it's a fixed rate. A fixed rate means their interest rate is fixed. It's not going to change. It's not going to go up and down. Okay. It's fixed. It's a conventional loan, which means it's not an FHA, nor is it a VA loan. And then this is their loan ID and MIC. We don't have to be concerned about that. Let's get into the meat and potatoes of it all. Amount. Have the client verify the loan amount. This is the amount in which they are borrowing from the bank. Let them know that this amount does not increase after closing because it says no, it does not increase. Make sure that that's the correct interest rate right here. And once again, this doesn't increase. And then this is their monthly principal and interest. I want you to pay very close attention to prepayment penalty. Now, a lot of loans don't have a prepayment penalty, but some do. This one does. So you need to go over this with the client. You need to let them know that if they do pay off their loan early within the first 2 years, because that's what it reads. Let me say, if they pay it off within the first 2 years, they can pay high as $3,240 if they pay it off. So this is how much the prepayment penalty could be, up to that amount. Okay, so let them know that because some clients want to pay it off early and some can, but let them know if they do within the first 2 years, they're going to be charged for it. Projected payments. This is really important to go over with the client and also understand it. Principal and interest. We already know. We went over principal and interest. The principal and interest matches this right here. Mortgage insurance right here. 8235. We will actually go over the private mortgage insurance later on in a later date. Estimated escrow account. This includes your property taxes and homeowners insurance. Why is this important? Because this is really important. This is their monthly payment. To be able to explain this, because they need to know, the first question that the client's going to ask is what my monthly payment is going to be and what does it include. Okay. But did you notice something though? This amount right here, let me zoom on in. This amount right here doesn't match this amount. This amount is more. Why is that? Oh, if you take a look at this information, you will see where it reads in escrow. So the property taxes and homeowners insurance is in escrow, but the homeowners association dues isn't. So that's included in that. Okay. So if the client asks you why are these two prices different, amounts different, let them know this amount includes your homeowners association. Okay. But for their escrow, this is the amount. This is that they're actually going to be paying. That's within their monthly payment is property taxes and homeowners insurance. So, and that's how much they'll be paying for the first 1 to 7 years, $1,050.26. Now, the next 8 to 30, they're actually going to be paying 967.91. And why is that? Because that PMI, that private mortgage insurance, is going to drop, and then now they're just going to be paying their escrow account and then their monthly principal and interest. So that's going to drop. Tell you that I would go over the mortgage insurance later. I'm going to just go over it right now. So this is the PMI, also known as mortgage insurance, private mortgage insurance. This right here is typically required if the client pays less than 20% on their down payment of the home. So believe it or not, yes, they charge the client if they put less than 20%. So that's the private mortgage insurance, and it's the protection for the lender. We see once it hits year 8 to 30, because it's supposed to fall off. You see it reads 1 through 7. It's supposed to fall off on that eighth year. So that's when the client's monthly amount goes down. Now, let's go over closing costs. You want to make sure that clients' closing costs matches what they were previously told or what the lender discussed with them. Front costs that the client will be charged to get the loan and to transfer the ownership of the property. Okay. And we already know what cash to close is. Of course, that's the total amount that they have to pay at closing, any additional money that they've already paid out. So they may have had to pay out of pocket for an appraisal. They didn't want to go with the appraisal that either the lender or title company suggested. So they paid out of pocket for the appraisal and other things. So that's how you explain closing costs. You let the client know these are costs associated with you getting the loan and the transfer of ownership of the home. Okay. And if you have any questions, put it in the comments. And next week we're going to go over page 2 of the closing disclosure, where it outlines the actual closing costs, where it breaks down the amount of the closing costs and the other costs that is associated with the loan. Thank you so much for joining me, my notary besties, and I'll see you next week.